Hi everyone. So in this live session today, we will be discussing about the second part of the basic income tax computation, which mainly revolves around dividend income. First would be we'll be discussing about how dividend income is taxed, dividend income, and what are the different types of tax reliefs that are available, tax reliefs that are available. We will also discuss about gifted donations and personal pension contributions. These are the three topics that we will be covering in today's class. So, in the previous session, we have discussed about non-savings income and savings income, where non-savings income should be given the first priority whenever we are calculating the taxation, and the rate bands should be first be utilized for non-savings income. Then, if anything is left in the higher basic rate or higher rate, that will move to the savings income. And after that, if anything is left over in the basic rate band, higher band, or additional rate band, that is when the dividend income comes into picture. Always the first priority should be priority given to NSI or non-savings income. Second priority should be given to savings income. Third priority, third priority should be given to dividend income. Always, this is the same case all the time. It should be the same for personal allowances and also when calculating your taxation. As I've mentioned in the prior class as well, whenever you're calculating the tax liability, always remember first you calculate the tax liability separately for non-savings income, then for savings income, and then for dividend income, so that you can remember all the allowances appropriately in the format. Like for non-savings income, you do not have any nil rate band or the starting nil rate band of first 5,000 like you have for savings income. Similarly, dividend in but in savings income you have, if your savings income falls within the first 5,000, then that will be taxed at 0%. And for basic tax rate payers, it is first 1,000 of savings income is zero rate band or the nil rate band. For higher rate, it is 500, and for additional rate, it is £0. Correct? Similar to that is what we'll be discussing about dividend income. So for that reason, it is very important that you calculate your income tax separately for for non-savings income, then for savings income, and thirdly for dividend income. It is very important to remember this, though the rate bands will be utilized in the continuous manner. Calculation of taxes should be starting from non-savings, savings, and then dividend income. All right. So now let's move on to dividend income. Dividend income is nothing but the income or the regular returns that you get on investing on the shares. The residual amount or the money that is distributed to the shareholders is known as dividend income. Correct? So whatever dividend is received by an individual, that also becomes taxable under income taxation. So now we'll start off with how do you calculate dividend income taxation? Always remember, it will always be the same format that you have studied earlier: NSI, savings income, and then dividend income. But the only difference that comes up is the tax rates. For non-savings income and dividend income, the tax rates are 20%, 40%, and 45%. But for dividend income, it would be, if the dividend income is falling in the basic rate band, then it would be taxed at 8.75%. Then, if they are falling in the higher rate, that is between 37,700 to 125, 140, that dividend income would be taxed at 33.75%. And if the income is exceeding 125, 140, it will be taxed at 39.35%. You do not have to remember these percentages at all because it will be provided to you in the examinable documents. It is just you need to remember how do you use your examinable documents, and that you should remember that dividend income, the tax rates are not same as as the normal non-savings income and savings income. If you remember this, you're at a good spot. This is about dividend income. Now, in non-savings in savings income, we have seen that we have something known as nil rate band, where if the income if the taxpayer is in the basic rate, then the first 1,000 of savings income is taxed at 0%. And if it's a higher rate taxpayer, then the first 500 of savings income is taxed at 0%. And if they're additional rate, we do not have any nil rate band for savings income. But for dividend income, you should remember that irrespective of the tax band that an individual belongs to first 500 of the dividend income is always taxed at 0%. At 0%. This is something that should be remembered at any cost, irrespective of the tax band. If you're a basic rate taxpayer, higher rate taxpayer, or an additional rate taxpayer, your first 500 of the dividend income is always taxed at 0%. Which means, let's take an example. Your non-savings income is 37,200 and 37,200 and there is no savings income and we have dividend income of 900 pounds. Okay, we have dividend and so that makes up our total to be, let's assume that this is after deducting, this is your taxable income and not your total income, which means these incomes are after deducting your personal allowances. So total income would be is equal to sum total of these. Now we have 38,100 on our hands. Now what will happen? First, taxation should always be done for non-savings income. So income tax liability. Here what do we have? 0 to, for non-savings income, it would be 0 to, because it is falling under the threshold of 37,700, it will be 0 to 37,200 will be taxed at 20%, which means is equal to 37,200 into 20% is 7,440. Next, we have dividend income, of which dividend income, how do we calculate it? Dividend income, we'll be calculating the tax liability. First, we have nil rate band. Nil rate band, 500 pounds at 0%. So it will be is equal to 500 into 0%. So now it is 0. Now what happened? The total basic rate band is at 37,700. But of that, 37,200 has been utilized for non-savings income. That means minus non-savings income, it would be minus 37,200, leaving available basic rate band to be 500 or is equal to sum of these both. Clear? So this will be less NSI income, NSI income. NSI income to be 37. Now, what happened? Now we are having a dividend income of 900, out of which first 500 is taxed at 0%, which means out of the available basic rate band of 37,700, the nil rate band is also taking up 500 pounds. Always remember, nil rate band should always be considered in calculating your total band availability, which means here we would have nil rate band of 500, making the basic rate band to be is equal to this minus this to be 0, which means now the dividend income is 900 pounds, out of which 500 is at 0%. The remaining 400 will now be part of the higher rate tax band. So higher rate band would now mean is equal to 900 minus 500 into 33.75% because he's a higher rate taxpayer. Is that clear? If you have any doubts, you can always reach out to me and I'll be happy to help you out with any of your doubts. Now, this is the total tax liability. How do we calculate total income tax liability? Income tax liability would now be is equal to sum of all of these, making your tax liability to be 7575. Always remember, any nil rate band, be it of savings income or dividend income, whenever a nil rate band is being utilized, that will have an impact on your basic rate band or higher rate band. If they're a higher rate band taxpayer, they say suppose they're having an income between 37,701 to 130,000, then it will affect the higher rate band as well. That 500 in savings income or dividend income will affect the higher rate band as well. It will utilize the value in it. All right. As you can see, the dividend income taxed at the dividend nil rate reduces the available basic rate and higher rate bands when determining the rate of tax on the remaining dividend income. This is a very important point to remember, because if you forget this, it will impact your calculations. And two things to remember for dividend income, that irrespective of the taxpayer that you are, you have 500 of nil rate band, and the tax rates for dividend income are different in comparison to your non-savings income and savings income. If you remember these 2 points, you will be at a very good spot with dividend income. Now let's try to solve some questions relating to dividend income and questions that involve all three types of income for better understanding. Okay, I think let's take up this question first, the previous question, and then move to a comprehensive question. So if you can see, Emain earned employment income of 34,250 and received dividends of 17,500 in the tax year 25-26. Calculate Emain's income tax liability for the tax year 25-26. Okay, so now what do we have? We have computation of Emain's income tax liability. Income tax liability is our question. Now, what do we have? We have non-savings income and dividend income and total, making it. Now, what do we have? First, we have employment income. Employment income, which is equal to 34,250. And next, dividend income is equal to 17,500. Now, after this, let's calculate total income. It will be is equal to sum these both, and then forwarded by dividend income. Now total income would be sum of these both, which is 51,750. Now what do we have? We have to deduct, because the adjusted net income is less than 100,000. As we know, there are no other adjustments like gifted donations or pension contributions. Adjusted net income is equal to total income. From this, we will be deducting personal allowance, less personal allowance. Always remember, you do not have to remember how much personal allowance is the value. You can always look it up from here. But as you start solving questions, you will get a hang of it. But whenever you're confused or you want to double check your answers, you can always take a look at the table so that to verify that you're taking the right amounts. All right. Now our personal allowance is 12,570. And what did I mention about personal allowance in the prior class? First priority to non-savings income. Then if any personal allowance is remaining, it will go to savings income. And if anything else remains, then it will go to dividend income. But right now, our personal allowance is only 12,570 and our non-savings income is at 34,250, which means the entire personal allowance will be reduced, equal to minus 12,570, giving us our taxable income of. And because the entire thing is being utilized by non-savings income, nothing will be left for dividend income. So now our taxable income would be sum total of these both followed by this. And now this will be sum total of non-savings income plus savings income's taxable income. And that is how you get your total income, total taxable income. Now, what are they asking us? They're asking us to calculate the income tax liability. So how do we do that? Income tax liability computation would be as, first we'll calculate income tax liability. First NSI's tax liability, which would be, how do we calculate it? First, we have 21,680. So 0 to 21,680 would be at 20% because it is under the threshold of 37,700. Okay, so which would mean it will equal to 30 is equal to 21,680 into 20%, because always remember, for non-savings income you do not have any nil rate band or starting rate band or anything of that sorts. So this would give us 4,336. Next, let's calculate dividend incomes tax liability. Dividend incomes tax liability. But before we do that, we should identify that total income is 39,180, which means it is above the threshold of the basic rate taxpayer. So he'll also be a higher rate taxpayer, which means if for non-savings income, a total of 21,680 has been utilized, that means is equal to 37,700 minus 21,680, which means 16,020 is the only thing that is available in the basic rate band. So for that reason, next in dividend income, what is the first thing that we consider? Nil rate band. Irrespective of the type of taxpayer you are, you will always have nil rate band of 500. So 500, so we should write nil rate band 500 into 0%. It would be equal to, is equal to 500 into 0%. So now here from 16,020, what do we have to deduct? Another 500, because in 37,700, the 500 has also been utilized. Always remember, these rough works play a very crucial role. Now you are left with 15,520 in your basic rate slab. So 15,520 should be taxed at 8.75%. If you're confused, take a look at the dividend rate. Honestly, guys, let me tell you, when I was preparing for my examination as well, I literally used to follow the examinable document as much as possible so that I do not have to remember all the unnecessary things, because that would lead to duplication of efforts. Okay. So now we know that it's 8.75%. So we will calculate it at 8.75%, making it a total of is equal to 15,520 into 8.75%. 720 into 8.75%, making it 1358. Now, what happened? Our total dividend income is 17,500. From that 17,500 is equal to 17,500. From that 500 is being taxed at 0% minus 500. And the other 15,520 is being taxed in the basic rate band minus 15,520 is being taxed in the basic rate band. So what is that leading to? 14,080 pounds in the dividend income, which should be taxed at higher rate band because 37,700 has been exhausted at this place, which means it would mean 1480 should be taxed at not 40%, but it will be taxed at 33.75%. 33.75%. So that would mean is equal to 1480 into 33.75%, means 499.5, making the total tax liability to be is equal to sum of non-savings income tax liability and dividend income tax liability. Should come up to 6194. Always remember, whenever you have different types of incomes like non-savings, savings, or dividend, Show the tax liability computation separately so that it will be clearer in your head and better in presentation. These questions will usually be asked for your section B, A and B guys, where they'll ask you to calculate the tax liabilities in simple questions. So when in simple calculations, you do not have to show the entire presentation anywhere. It is just that to ensure that your clarity of thought continues and is persistent, which is why we should ensure even in our rough work, we do it in this manner. All right. With this, we can move on to the next part, next question, wherein we have three different types of income. One is your savings income, we have non-savings income and dividend income. Let's start off with the question. Matteo received dividend income of 1,500 and bank interest of 375 pounds in the tax year 2025-26. He also has trading income. Assuming his trading income, the tax year 25-26 is as follows. One situation is 15,500. The second situation is 51,595. And third is 149,875. If we take 149,875, we know both of them will be in the higher rate band because obviously it is exceeding 125, 125, 140. So we know we'll have to take the higher rate tax bands. So let's take the scenario of B. Okay, where the income is at 51,595. All right, when the income is at 51,595, what is that we should consider? The first thing that we will be considering should be the presentation, income tax liability computation, which would be at, how do we do it? Always remember, non-savings, savings, DI total. In this, it would mean that first we have a trading income, which would be at 51,595, and our non-savings income would be at 51,595. Next would be our bank interest. Bank interest means it is interest that has been received. So that should be at savings income. It would be at 375 pounds here. And after that, we have received dividend income of 1500. Dividend income of 1500. Now this is our scenario, making that total income to be for non-savings. It is sum of, it is equal to this because there are no other incomes. For savings income, it would just be the bank interest received. For dividend income also, it's just the dividends of 1500 received. This total will now be equal to sum of all of these to be 53,470. From this, what do we deduct? We deduct personal allowance. Personal allowance is 12,570 and the entire thing can be utilized by non-savings income. So we will deduct it from the non-savings income directly minus 12,570, giving our taxable income to be equal to sum with this one. Now we have calculated our taxable income and it is time to calculate our income tax liability. First, non-savings income, it would be 30, so it is coming up to 39,025, but our basic rate band is only until 37,700. So here it would mean that 0 to 37,700 should be taxed at 20%, which means is equal to 7,700 into 20%, 7,540. Next, what happened? The remaining part of the non-savings income would now be taxed at the higher rate band. So how much would that be? Remaining would be rough work. If you can take off the rough work off, is equal to 39,725 minus 37,700 would be at 1325. Remaining 1325 would be at 40%. Can get is equal to 1325 into 40%, giving you your total to be 75040 plus 530. Now we have completed savings income. Let's move on to non-savings income. Sorry, non-savings income is completed. Let's move on to savings income. My bad. Savings income. In this, what do we have? We have only 375 pounds. And what did we identify? Because here the person is a higher rate, is a higher rate taxpayer as it is more than 37,700, then savings income nil rate band would be at 500 pounds as is a higher rate taxpayer. But here our savings income is only 375, which means it will fall entirely in the nil rate band. So now the savings income would now mean nil rate band. It would be is equal to 375 into 0% equal to 0. Savings income is completed. Next, moving on to dividend income. Now we know that dividend income is 1500, but irrespective of the tax slab, first 500 of dividend income is always taxed at 0%. So nil rate band. Let's also take nil rate band again. Is equal to 500 into 0%. Here, remember students, we are not calculating the availability of rate band because the income is less than 125, 140. So there is no slab changes, but entirely everything would be under the higher rate slab. So because of that, this would be 500 would be 0, but there is still 1000 of dividend income left. And we have already identified that Matteo is a higher rate taxpayer because he has moved into paying 40% tax on non-savings income. That means this would also be taxed at higher rate. So the remaining 1000 should be taxed at 33.75% or the higher rate that is available, which you can see to be 33.75%. So now that would mean is equal to 1000 into 33.75%, making it a total of total tax liability to be equal to sum of all of these, giving us 8407.5 or 8408. And that is how you should calculate your question. This is your answer here. All right, if you have any doubts, you can always reach out to me and I'll be happy to help. With this, we have completed solving questions relating to dividend income as well. And I would want you to try out questions, test your understandings 4 and 5. And I want you to reach out to me if you guys have any doubts in relation to these questions. During this practice, it is also important that you show the presentation of these as well so that you can make it a habit for your final examination. Okay. With this, let's move on to the next topic, that is about income tax payable. Here, so far, what we have calculated is income tax liability. But now we are trying to identify what is the difference between income tax liability and income tax payable. It is very simple. For example, income tax liability is the total tax that you have to pay from all the incomes that you have received. But income tax payable is nothing but the amount that you have to personally pay after the payee has been deducted. Don't worry, I'll explain what payee means. Pay is nothing but if a person is employed with any other organization and they're falling within the taxable income threshold, what will happen? The company itself will provide their salaries after deducting their income tax liability, which is also known as pay as you earn. So in the UK, whenever a person is employed with any organization and they have a tax liability, they will be getting their income net of their employ income net of the income tax liability that is to be paid to the HMRC. So because of that, when the total tax liability exists of a person, from the total tax liability of an individual, they only have to pay income tax payable would be the total tax liability minus pay as you earn. Pay as you earn is a very simple concept. How much ever tax is already being paid by HMRC. Because if you don't do that, what will happen? You will calculate your total tax liability, which includes your employment income as well. And because of that, you'll get a total tax liability, wherein it includes tax that is relating to the employment income. But tax relating to employment income is already being deducted from your payroll itself. So because of that, the tax might lead to being paid twice. In order to avoid that, your tax payable would be net of income tax liability and your payee or pay as you earn. All right, hope this is clear. This is a very small topic. You just have to remember whenever they ask for income tax payable, always remember to identify if any tax is being paid by the employer, that is to be deducted to get your income tax payable. Otherwise, it will be income tax liability. All right, with this, let's move on to the next part of the question, which is talking about reliefs against other income. So as we have earlier discussed about in the prior class, we have discussed about what is net income and what is total income. So from your total income, if you deduct less any reliefs that are available, you get your net income on which you will deduct personal allowance to get your taxable income. So in this part, we will be discussing about what all are the reliefs that are available in order to make your total income to your net income. So there are two major reliefs that are available in which we will be discussing about only one kind of relief here, because the other kind of relief is relating to chargeable gains, and we will discuss that when we are studying the chargeable gains chapter. All right, until now, but until then, we will be focusing on only one, which is known as qualifying interest payments. Okay, the second one is known as loss relief, which is relating to how the trading losses that you make, how are they set off, and any chargeable gains or any chargeable losses that you make, how they are set off, are the two other reliefs which we'll be discussing in trading losses for individuals and also chargeable losses. We will discuss those when we get to those chapters. But right now in this chapter, we'll only be focusing on this point, that is qualifying interest payments. Qualifying interest payments is nothing but we take a loan out for a specific purposes. Okay. And on that loan, we have to pay interest. So whatever that interest is being paid is always acting as a relief, but only in specific conditions. Any interest paid on the qualifying loans taken is to be deducted from the total income to compute your net income. Now, from this, let's try to identify what are those qualifying loans. Qualifying loans are of two types. Qualifying loans are of two types. One is for employees and the other is for partners in partnership. in a partnership. So whenever an employee takes out a loan either to purchase a shareholding in the employed company, the interest on the loan that is taken to purchase shares in the employed company will be considered as a qualifying interest. Will be considered as a qualifying interest. Okay, for suppose I work at Tata, and now this is just an example. I work at Tata Group, and in that Tata Group, I want to purchase the shares of that company, but I do not have sufficient funds to purchase the shares of that. So what do? I take out a loan, and with that loan amount, I invest into the Tata Group. So whenever I do that, I'll have to pay interest on this loan that I've taken, on the loan that I've taken to purchase the shares. So whatever the low interest is to be paid, that will be deducted from your total income to calculate your net income. Similarly, if an employee purchases any plant and machinery that is used in the that is used in the employ that is used for employment purposes, then the interest on the loan taken to purchase this P&D, to purchase the plant and machinery, is also deductible from total income, is also deductible. Guys, pardon my spellings, right? Okay, let me just bring it up or highlight it so that it's easier for you guys. So first thing, if you want to if you take out a loan to purchase shares in the company that you're already working for, the interest paid on that loan can be deducted from your total income. The next is, if you're taking out a loan to purchase plant and machinery that is used for exclusively for the employment purposes, then the interest paid on that loan can also be deducted from your total income. That is what it is relating to the employees. For partnership, also it is similar, wherein if a partner takes out a loan to purchase share in the partnership, the interest is deductible from the total income. Next, again, if a partner purchases plant and machinery by taking a loan for partnership, that is, if you can see, for use in partnership. So for business purposes, that is being used by the partner, whatever plant and machinery that you take by taking out a loan, that interest is also deductible. For partnership and used by the partner, then the interest can be deducted from the total income. So first, there are two categories for qualifying loans. One is for employees and one is for partners. For employees, it is if you want to buy shares, you take out a loan to buy shares in the company that you work for. Interest is deductible. Next, if the employee purchases plant and machinery that is used for employment purposes and then used for employment purposes by the employee, then it can be deducted. But the second case is when you're in a partnership, That is, I am a partner and I take out a loan to purchase share, and I want to become a partner in in a partnership, and I take out a loan to purchase the partnership. The interest is deductible from total income. Always remember, it is to be deducted from total income. Purchases plant and machinery by taking loan for partnership, or plant and machinery, you're in a partnership, so you're running the business, and in that business what will you have? You will have to use plant and machinery, correct? So that plant and machinery that is being used by the partner himself is also deductible. The interest on that is also deductible. This is all about qualifying interest payments. If you have any doubts, you can always reach out to me. All right. Next is loss relief. As I mentioned, we'll discuss loss relief in detail when we move to that chapter, and losses for trading individuals, and also for chargeable losses for chargeable losses. You do not have to worry about it. So next, with this, we have completed the qualifying reliefs that are available. So now let's try to solve a question relating to it. Anwar and Mila each have total income of 54,000. So, and none of which is savings income or dividend income. That means they are only having non-savings income. Made the following payments during the tax year. Anwar made interest payments during the year totaling 2,000 on his mortgage for his main private residence. Here, what is happening? There's a mortgage payment is being mortgage payment. So on that, there is an mortgage has been taken on the private residence, and on which he's making the interest payment. Is that a qualifying loan? It is not for employment purposes or to buy any share in a partnership or shares in the employed company, or it is to purchase in plant and machinery. So does that qualify as a qualifying loan? It does not. Okay, so because of that, there will be no tax relief that will be available for this. All right. But next, Formula has made interest payment of 2,000 on a loan to invest in a partnership in which she is a partner, which is satisfying our criteria that a partner is taking out a loan to purchase share in the partnership, which means it is satisfying this criteria. So whatever Mila's interest payment is there, that you will get a relief on that, and it can be deducted from your total income for Mila. But for Anwar, you will not be getting any kind of relief. Okay, with this, let's solve the question. Calculate income tax liability for Anwar and Mia for the tax year. Okay. So first what we'll do is we'll calculate for Anwar, and next we'll move to Mia. Okay, so Anwar, what is he having? Each of them are having non-savings income. So here he's having only non-savings income. So employment income. Okay, let's write total income given to us already. Total income is 54,000. From that, do we get any relief? Less reliefs. We do not get any, so we mark it with a 0 to get net income to be is equal to this minus this 54,000. So we have got our net income. From this, what do? We should deduct our personal allowance, less personal allowance, which should be equal to minus 12,570 to get our taxable income, which should be equal to is equal to sum of this minus this, which will be equal to 41,430. Now that is a taxable income of Anwar. So how tax liability of Anwar would be? Tax liability of Anwar, how do we calculate it? 0 to 37,700 would be at 20%, which means is equal to 37,700 into 20% would be 7,550. And the total taxable income is 41,430, out of which 37,700 is being taxed in the basic rate, which means the remaining amount would be Remaining amount would be at higher rate at 40%. 40%, that would mean is equal to 41,430. Let's open the brackets, minus 37,700 into 40%, making the total tax liability to be equal to sum of these both, giving us 9032 as we can see here. Okay. Next, we have calculated for Anwar. Now, next, move on to Mila. So, Mila over here has total income of same 54,000, but from that, less relief that is available. What do we have? Qualifying interest payment relief. Qualifying interest payment relief, which would be equal to interest payment. How much did she pay? She made interest payment of 2,000. So it would reduce minus 2,000, giving her net income to be to sum of these both be 52,000. From that, we will deduct less personal allowance. As the adjusted income, net income is less than 100,000, we do not need to calculate changes in the personal allowance. So it will directly be minus 12,570, giving us our taxable income at is equal to sum of these both. Always remember, if you use a minus symbol appropriately, then you can directly use the sum function. But if you are not using the minus symbol, then alternatively what you should do is equal to this minus personal allowance is something that you should do. Okay, here I've used the minus symbol, so that is not required, but otherwise it is something that you should be following. All right, now we have calculated the taxable income. Next would be tax liability of Mila. So basic rate band would be 0. Even here you can see that it's exceeding 37,700. So the entire 37,700 would be at 20%, is equal to 37,700 into 20%, 7540, and remaining at 40%. How much is remaining from out of 39,430? 37,700 has been utilized in basic rate band. 37,700, making that should be multiplied with 40%, which would give us 692. Therefore, tax liability of Mila would now be at is equal to sum of these both, the total of 8232. And that is how we calculate it. As you can see, is the same answer here. Always remember, whenever they give interest payment, always never think that okay, interest payment has been given, it should be deducted. It should be deducted as a relief. Only remember, interest relating to qualifying loans is the only relief that you are getting, and these four are the only qualifying loans. One is shares of employer. Next is purchasing plant and machinery for the use in the employment. If in a partnership, loan taken to purchase shares in a partnership, and the loan taken to purchase plant and machinery for the use of in a partnership by the partner. Only then you will be having that available. Otherwise, it will not be there. All right. After completing this, we will next move on to the next important concept, that is discussing about charitable donations and gifted donations. We will be discussing both charitable donations and gifted donations. Okay, charitable donations and personal pension contribution, because both of their treatment is very much similar. Why do we need to know about charitable donations? There are two reasons. Charitable donations are required for two purposes, required for two purposes. The would be one would be to calculate adjusted net income for personal allowance reduction calculation. The second purpose of it would be to know about how much bands will extend. I will discuss this in detail as we in the current class itself, but this is an overview about it. Okay, much the tax bands will extend. Tax bands will extend. Okay, so first we will understand about charitable givings. Now, charitable donations are nothing but the donations that an individual makes to any charitable organization is known as charitable donation. Okay, so there are two types of charitable donations. One is donations under gift aid scheme, and the other is payroll giving under payroll deduction scheme. These are the two types of charitable donations that are available. Okay, one charitable donation is under gift aid scheme where you individually want to donate to someone, and the other is about payroll giving wherein in your payroll you tell your employer to do like, okay, I want to donate to this organization, so directly automatically deduct it from my salary that I receive. These are the two types of donations that you tend to have. So in the first one is what we will be discussing right now. Okay, the first one is always that we care about right now, because the second one will directly be reduced from your employment income. But donations under gift aid scheme will not act as deductions, but there is a different treatment to it. What is the treatment? Okay, there are two types of advantages. When you make a gift aid donation, what is that? For suppose aid decides to make a gifted donation of 800 pounds. Okay, wants to make a gifted donation of 800 pounds. Now what will happen? You decide to make 800 pounds. Then in addition to what you decide to donate, what does HMRC do? HMRC adds 20% to your gifted donation on behalf of you. Okay, so if you decide to make 800 pounds, you say that, okay, I will pay 800 pounds. And on behalf of you, HMRC makes another 20% of it. So into 20%, making it a total donation to be is equal to sum total to be 960 pounds. So this is your net donation and this is your gross donation. Though you have made a payment of only 800 pounds, but the charitable organization is only actually getting 960 pounds from the gifted that from the donation that you have made. Always remember, this is an important point to remember. But now, in addition to this, what do you get? In addition to this, what happens is how much ever gross gifted donations exist, gifted donation is made, that much amount is added to your basic rate band and higher rate band, basic band and higher rate band, which means, for example, you have made a gifted donation, gross gifted donation of 960 pounds, correct? And what is the basic rate band? It is only 37,700. But because of the gifted donation that has been made, what will happen? Your basic rate band will increase from 37,700 to is equal to 37,700 plus 960 pounds to 38,660. And if you're a higher rate taxpayer, what will happen? If you're a higher rate taxpayer, the higher rate band will move from 125, 140 to is equal to 125, 140 plus 960, which means up to 38,660 will be taxed at 20%, and up to so from 38,660 to 126,110 will be taxed at 40%, which means you are getting an additional 960 pounds to be taxed at lower rates. I hope this is clear. If you have any doubts on this, you can always reach out to me and I would be happy to help. Okay, so this is now what we have discussed about charitable donations. Whatever we have discussed about charitable donations is the same concept that is applicable for pensions as well. In pensions as well, don't worry, we will solve a question to understand this. You do not have to worry at all. This is to give an explanation about how it is done. In pensions as well, we will discuss more in detail when we come to pension income. But in pensions as well, there are two types. One is personal pension contributions, where an individual decides, like, I want to save some money for my future after my retirement. So every month or every during every year, I want to put aside some amount into a pension contribution, and that amount will be treated in the same manner, which means if you decide to make 1000 pension contribution, 200 will be made by HMRC, giving you a total gross contribution gross contribution to be 1200 pounds. And in the same way, if it is 1200 pounds of contribution, then your rate band will increase from 37,700 to 37,700 plus 1,200, and your higher rate will move from 125 140 to well to 125 140 plus 1200, which means additional 1200 pounds. Though you have made contribution of only 1000 pounds, your total is actually increasing by 1200 pounds, not by 1000. Whenever, always remember, if the question clearly says the gross contributions were so and so amount, then it is this amount. You need not have to add the plus 20 percentage. If it does not say that, then to whatever your contribution is, you will have to add 20% in order to get to the gross contribution. And but this is about personal pension contributions. Same thing will happen. First, it is 1000. First, it will increase by 200 by 20%. First, it will increase by 20%, and next, what will happen? Your rate bands will extend. This is something that you will have to remember at any cost. All right. These are the two important points. In pensions, we also have something known as employer pension employee employment pension contributions, which similar to your similar to what we have done with charitable donations, which is payroll charitable donations. They will be deducted from your employment income. All right, with this, let's try to solve a question to understand it better, but before that, let's give it a better read in order to help you guys understand it better. Okay, donations made under the scheme attract relief at donors highest rate of tax. Minimum or maximum contribution limits, you can contribute how much ever you want, and how much ever you donate, 20% will be added by the HMRC, and along with that, your rate band will also extend by that amount. Okay, this is how you should calculate it. Whenever a gross amount is given, so let's assume they have given the gross amount to be 1,000, and they want you to calculate how much was the actual contribution made. Actual contribution made by the individual. individual. How do we calculate that? It is nothing but, let's say it is 1000 has been made, is equal to 1000 into 100 by 80 gives you, okay, so this is 80 by 100, it's my bad. 100 will be 800. All right. This is how you get it. How the tax relief works. All right. But now let's discuss about if an individual, let's assume if an individual is a basic rate taxpayer, is a basic rate taxpayer. Okay. Basic rate taxpayer, which means his income is is under the threshold of 37,700. So for that individual, is there any benefit of extending the rate band? No, there isn't any because his income is already falling under the threshold of 37,700. So he'll anyway be taxed at 20%. So the only benefit for basic rate taxpayers would be the grossing up that happens, would be the grossing up by 20% that happens. But if the individual is a higher rate taxpayer, then there are two advantages. There are two advantages. One would be one would be that it would be grossed up. It would be grossed up. And the second one is what we have discussed would be the extension of bands. Extension of bands. All right. So a person who is having a basic rate band of only up till to 37,700, because of the donation made of 960, now his up to 38,660 would be taxed at 20%. Correct? Now let's see how that is beneficial. Let's take it was no contributions made. Okay, there are no contributions made. And his income is 38,660. Let's assume his income is 38,660. Now, what will happen up to 37,700? It would be taxed at 20% and 20%, and the remaining 960 pounds, which is equal to 8,660 minus 37,700 would be 960. So is equal to 960 would be taxed at 40%, correct? Making his total liability to be 7924. But now assume that he has made a gross donation of 960 pounds. What will happen? The basic rate band will extend to 38,660, which means the entire amount of this individual, 38,660, is now being taxed at 20%. So that means earlier he was paying $7,924 of pounds of tax, but now he's paying only 7,732 pounds. And that is how the tax savings work. All right. I hope everyone is clear on this concept. Do not worry. This is a very simple concept. If you put some efforts into going through the class, listening to the class, and solving the questions parallelly, like while we are doing it, you will understand it in a very easy manner. All right. Now let's solve a question relating to this for easier understanding. Okay. Brenda has employment income of 55,000 each year and makes a payment of 3600 to RSPB, which is probably a scheme under the gift aid scheme. So here a donation is being made under gift aid scheme. So here what will happen? She's making a payment of 3600, which means it is a net amount. So this should be grossed up. How do we do that? First, we'll calculate employment income is the only income that she has. So that means it will be 55,000. From that, we can directly deduct personal allowance. Personal allowance would be minus 12,570 because he's under the basic rate band. So here what will happen? Taxable income would now be is equal to sum deduct both of these to get your taxable income to be 42,430. So now what will happen? Income tax liability computation. Here what is happening? There is a donation of 3,600, which means your basic rate band and higher rate band will extend. How much will they extend by? We'll calculate the working. One, computation of extension to the rate bands. Extension to the rate band. How much is the contributions made? Gifted donations made? Donation made would be 3,600. Next gifted donation is 3,600. Now gross gifted donation would be equal to is equal to 3,600 into 100 by 80. Oh, sorry, I missed a percentage symbol. Into 100 by 80, making your gross gifted donations to be 4,500. All right, clear on this? This is your gross gifted donation, which means now your rate bands will extend by 4,500. Extension of basic rate band would be is equal to 37,700 plus 4,500, making it 42,200. So 0 to 42,200 would now be taxed at 20%, equal to 42,200 into 20%. Remaining tax debt will happen at 40%, which will be nothing but is equal to 42,400 minus, did it take 42,200 only? Yeah, 42,200. But here your income is equal to 42,430 minus 42,200 into 40%, can get a total of 92 pounds. So total tax liability would now be equal to sum of these both. 8532. Always remember, easiest way to make grossing up is take your net donations into 100 by 80 will give you your gross donations. All right. And that is how you should solve any questions that include donations under gifted scheme. With this, we come to the end of the chapter. In the next session, we will be solving few questions relating to, we will be solving a few questions along with where we will also be discussing about how the residency of an individual is identified and further topics that are relating like any transferable allowance, and all of those are a few topics that we will be discussing in the next session. So guys, I want you to come prepared before you move to the next session, because these three chapters that we have completed so far, these three the classes that we have completed form the ultimate foundation to your entire preparation of taxation. If you get these is only when you will be able to score better marks in your coming sessions. Otherwise, it would become very difficult for you. So please understand this and practice as many questions as possible, because I've already shared the study text and kit with you. After you listen to the recording, try to solve the test your understandings. We will be solving them in the live sessions anyway, but it's also important for you to practice and understand the concept. Try to solve them. And if you have any doubts, always reach out to me. I would be happy to help. All right. Bye, everyone. See you guys in the next session.